Hello, good morning to all. Welcome to today's Daily Dose of Market Insights. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. Well, we come close, today is the end of February. That means 2 months has already passed for the year of 2024. Very good morning. Today will be Thursday, end of February, 29th of February 2024. All right, so before we start our Daily Dose of Market Insights, let's take a look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses could exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. As well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Pardon me. All right. So before we jump straight into the short-term technical outlook on the various cross-asset classes, let's have a recap of what has taken shape yesterday in terms of the cross-asset performance. Economic data to look up, economic data that has already been released, as well as events for the last night US session, and most importantly, later I'll share with you today's Asia session. Why? Because the Japanese yen actually is the strongest performing currency against the dollar, but that actually came more or less within our expectation. Why? Because the dollar yen actually struggled right below a key short-term pivotal resistance, which is 150.70, 150.80 in the last 2 weeks before today's Asia session. Intraday dollar yen sold off right at today's early morning Asia session time. Okay, so over here, let's start with the benchmark US stock indices first. All right, so the benchmark US stock indices was rather lackluster. So actually, that is more like a profit taking activities taking shape throughout. Coming close to the end of the month effect. So you could see over here is that the strongest performing benchmark US indices with the Nasdaq 100 in the last since the start of this year is the worst performer yesterday, down negative 0.5%, followed by the SPX down negative 0.17%, the Russell 2000 down negative 0.7%, whereas the Dow Jones Industrial Average almost unchanged, negative 0.06%. So you see it's a bit of more like a profit taking adjustment or a portfolio adjustment, month-end portfolio adjustment by traders or fund managers to actually do a bit of rebalancing from from the strongest performer, which is i.e. the Nasdaq 100, and rotating it back to the laggards, which is the Dow Jones Industrial Average. So if you look at the hit of the S&P 500, it's pretty much obvious of what we see over here. So this was yesterday's intraday performance of the S&P 500 component stocks, all of them. So you see the weakest performer is the Mega 7 cap stocks, which is the high mega cap technology stocks. Like Nvidia was the worst performer yesterday, followed by Google. Okay. Then Apple and Meta as well, both down. Both of these, 5 of them down negative 3% to close to 2%. All right. So what you could see is a bit of rotation of the outperformer. That means what you call it, profit-taking outperformer, spreading back towards the laggards, which is the banks, the industrials, all right, as well as the energy. And part of it we go to the materials as well. Okay, so it's not like a signs or what I call a medium top that has really formed in the US stock market. Okay, then what we could see, or another factor over here, is that the US 10-year Treasury yield continue to remain lackluster below the 4.3% lower boundary of the major resistance that we keep on highlighting in the last 2 weeks or 4 weeks or so. So if you look at the US 10-year Treasury yield over here, okay, it continues to remain lackluster below 4.33%, which is the lower limit of this 4.33/4.5 major resistance zone. Okay, then the RSI also shaping lower high. Okay, so what we could see over here is it's kind of remains sideways for now, holding above 4.14%, as market also await of key data that is taking shape later today. So later I'll share towards the end. In fact, there is one key very important data to watch out for during the US session today. Okay, so given this lackluster movement of the US 10-year Treasury, that is neither here nor there, that also kind of prevent any significant sell-off in the major US stock indices. Then on top of this sluggish US 10-year Treasury yield that is trading in the sideways range right now, the dollar index also, the dollar strength also remains kept as well below the 104.85 key resistance level on the dollar index. All right, so this is a dollar index. So what I mean by dollar index, if the price action is going upwards, that means representing aggregate dollar strength on the average. If this price action is sloping down, is coming downwards, is representing dollar weakness. Okay, so we could see over here in the last 1, 2, 3, 4, 5 session, this is a daily chart. It has been testing the key 200-day moving average. Okay, I think as a key near-term support at this 103.70 level mark. All right, so net overall, what you could see over here is that there is no clear signs of dollar strength resurgence back into the FX market as a whole, on average, because this is not individual, it's a dollar index, so it comprises the euro, the sterling, the yen, but it doesn't comprise the Aussie and the Kiwi. So for those who actually follow our daily dose of market insight, the Aussie and the Kiwi is moving slightly out of line with the rest of the other currency. So later I'll share with you the Aussie dollar, because Aussie dollar, for those who recall, keep on following our daily dose, yesterday we have a bearish bias on the Aussie dollar, and it really hit the support level at around 65 figure level yesterday. So where does the Aussie dollar go from here? Like I mentioned earlier on, the dollar index doesn't have the Aussie and the Kiwi inside, and in fact the Aussie and the Kiwi right now is shaping a slight directional bias that's a bit different in terms of the technical configuration from the rest of the other major currency. Okay, later I'll spend more details on the Aussie dollar on that aspect of things. Okay, so then what we have over here is we do see gold pretty much sideways as well, and WTI crude oil price managed to pierce past above the 79 figure level, but thereafter it managed to trip back below again in the later part of the US session. So it's more of like a whipsaw movement for the West Texas oil, and also pretty much sideways on the spot gold as well, XAU/USD, because it still can't break above its key we call it range resistance, short-term range resistance at the 2042 level mark, but also didn't break below a key short-term support at the 2022 level as well. Okay, so these are the what you call it, the broad asset class movement that has taken shape yesterday. So now let us move on to the events. So in terms of events over here is that yesterday we do have a slew of Fed speak. That means what is Fed speak? That means Fed officials doing their public speeches. All right, so we have 3 of them speaking yesterday. So all of them singing the same tone, saying that three of them saying that the pace of the interest rate cut will depend on incoming data, suggesting the path to lower borrowing costs may look different than the previous rate cutting cycle. That means what it means over here is that yes, the Fed will likely cut this year. All right, so now the market expectation at the start of the year, they're actually penciling much. Then after we have a slew of rosy US economic data, the first rate cut expectation has been keep on pushing backwards. That means from March to May, then now the highest probably the first rate cut will be in June. So what the Federal Reserve official has tried to transpire or guide the market that yes, even though we may cut in June right now as a higher probability as being detected or indicated by the Fed Fund futures pricing, that means i.e. the CME Fed Watch 2. Later I'll share the Fed Watch 2. For those who has been keep on following our daily dose, you guys shouldn't be totally strange to this Fed Watch 2. Yeah. So what they actually transpire over here is that yes, even though they may cut in June, but it doesn't mean that the next meeting there will be a successive rate cut. So that's what I mean by how it may look different in the previous rate cutting cycle. All right. Then based on Williams, he actually make it very clear it's not going to be a calendar base. That means i.e. following month on month, and it may not be on a fixed schedule, but focus on data. So what it means that he's trying to actually tone down the speculative, we call it expectation by some market participants that once the Fed starts its first interest rate cut, that means i.e. the next subsequent month, they will keep on cutting. All right. So that is not going to be the way that the Federal Reserve going to operate in this potential upcoming interest rate cut cycle. Okay, so this is being transpired into the market right now. That means, i.e., how does it goes to the Federal in terms of market movement? So do not forget over here is that in order for risk assets to rally right now, we need to have liquidity coming into the market. And the only way liquidity will get added in over here, given that the ongoing quantitative tightening phase that is still ongoing right now, by the Fed, is that interest rate got to come down. All right. So what you see over here is that there got to be a uneven path of potential interest rate cuts going forward. All right. After June, let's say potentially that is the first rate cut. That means, i.e., the second half of this year, the market movement in terms of a one directional move up will be less likely for stock indices. All right, that means market may not repeat what we see earlier that take shape in Q4 of last year and the early part of this year. That means, i.e., the first 2 months of this year. That means it's not going to be like a very one-way ticket up to the upside for the major US stock indices, given that the Federal Reserve officials has given an indication that the Federal Reserve interest rate cut potential cut cycle will not be in every other meeting. After the first rate cut in June, it may cut and they may pause for a while before deciding what to do next. All right, so that actually transpired that if you look at the CME Fed Watch 2, share with you all. Okay, let me share the CME Fed Watch 2. So for sure, right, this month, upcoming this month, this March FOMC meeting, the potential interest rate cut probability is back almost to what, less than I think 10%. All right, so let me share with you. Yeah, it's only 2.5% now. Bear in mind the current Fed fund rate is 5.25% to 5.5%. So this is the 20th of March meeting. So the outcome very unlikely the Fed will cut. So if you look at May over here, also very unlikely. Why? Because 80% expect it to stand pat. Only 2% expect to cut. So the one that is as a higher probability still will be in June so far this year. But will this thing change? Yeah, for sure. After today's key economic data event, after a key economic data released today, potentially it may change. All right. So if you look at the entire probability, so there's one probability tab where you could see the table as a whole in terms of calendar month. So we could see over here the one that has the highest easing so far, 61% is in June. Okay, so what you could see over here that for sure we know June will be the first interest rate, potential first interest rate cut. Okay, by adding 51 to 10%, because 10% expecting a 50 basis point cut, 51% expecting a 1 basis point cut. That's how we are. Then after that, you count down towards the end of the year. Okay, one time potentially in June, another time in September, but however July there will be none. There will be no cut potentially pricing in July after in June. So one time, two time, 34% chance in November, then thereafter only 28% chance in December. So if you count it down, 1, 2, 3. So far, based on the current pricing by the CME Fed Watch 2, the market participants have started to reduce the interest rate cut. The total expected interest rate cut for 2024 at the start of this year was 6. Then afterward, it reduced to 4. And right now, it has reduced to only 3. So these 3 interest rate cut potentially as being priced by the interest rate futures market is in line with the dot plot expectation. What is dot plot? Dot plot is the median projection by Federal Reserve officials in their forecast on inflation rate going forward, as well as the Fed funds rate trajectory. So the last dot plot was released in the previous meeting in December, where they actually penciled in potentially 3 interest rate cut for 2024. But at that point in time, the Fed was very, very dovish. So market was actually expecting 3 more cuts than their median projection of 3 cuts transpired by the dot plot. So market expecting 6, the Fed only saying that, hey, we only potentially could do 3. So based on that huge divergence and the hotter than expected US data that came out in the last 2 months or so, this we call it divergence has been totally been removed. So now what market is expecting right now is they have 3 cuts in line with what the Fed projected 3 cuts as well. So going forward, right, this coming March meeting, Federal Reserve meeting, like I said earlier on, will be very important. Why? Because this 19th and 20th March FOMC meeting, 20th will be the outcome, 20th March. So 20th March meeting, the Fed will also release their latest dot plot figure. All right. So if this latest released dot plot figure is in line with what markets are expecting, which is 3, nothing big changes. So if the Fed starts to reduce the dot plot, that means instead of 3 interest rate cut they are expecting for this year, they reduce it to 2, then that could be a potentially huge change in terms of market pricing by the Fed, the CME Fed Watch 2, and also potentially that could create a negative knee-jerk reaction in terms of the major stock indices. That means, i.e., we potentially could see a spike down in the stock market. We could see a spike up in 10-year US Treasury yield, and potentially we could see also a spike up in the US dollar at that point in time. If on 20th of March, the Federal Reserve officials start to reduce their expected interest rate cut for this year from 3 to 2. All right, but for sure, if that for whatever reason they start to increase it to 4, I think that's very unlikely. Then that could start to see the reverse happening. That means a spike up in the benchmark US stock indices, a spike down in the 10-year US Treasury yield, and a spike down in the US dollar index. Okay, so this is something extra that I share with you all on the what I call it, the feedback loop, potential feedback loop at play, taking into account of current market expectation. All right. Now, another news I share with you all is what we could see over here. If you look at the FX market right now, this is the 5-day rolling performance of the major FX pair. That means plotted against the dollar. Oops, sorry. That means plotted against the dollar. That means dollar as a base currency. So I could see the clear outlier was dollar weakness against the Japanese yen. All right. So this is something that potentially could happen. Why? Because we do highlight earlier 2 weeks ago, the dollar yen seems to be the dollar's yen, that means dollar strength, seems to be getting very hesitant at a key resistance at 150.70, 150.80 in the last 2 weeks. They can't break above this level. And today's catalyst that causes this reinforcement of this dollar weakness against the yen was actually from BOJ speech. There's a BOJ, we call it officials called Takata. He did mention in public speeches today, right early the Asia session, that momentum is rising in the spring wage talks. Why is it important? Because one of the key metrics that BOJ is watching, other than Japanese inflation numbers, is how forceful will wages rise in Japan for this coming financial year. And in Japan, it's a bit slightly different. Before the start of every new financial year, and Japan financial year starts in April. It's different from us. It's not calendar year, financial year. That means the start of Japan new financial year is not start of January 2024. It start in 1st April 2024. So before every financial year starts, between January to March, the labor union in Japan will actually do a major wage negotiation talk with their company. All right, with the company. And in the last 2 or 3 months, BOJ Governor Yuda, he said that in order for BOJ to be more confident in normalizing monetary policy, that means i.e. removal of short-term negative interest rate is the first step, and potentially remove the yield cap of the YCC on the 10-year JGB, he got to see potentially wages increases. Why? Because wages increases will start to see a much more resilient demand pool CPI data coming forward. And one of the reasons wages got to increase is the wage spring talk got to take shape That means benefiting the workers rather than benefiting the employers. So based on this particular positive news flow saying that this BOJ officer, that means he has some findings indicating that momentum is rising on the spring wage talk. That means, i.e., the unions are gaining traction to better negotiate higher wage increases on behalf of the workers. That means potentially there could be a higher chance of a wage increase going forward at the start of a new financial year in 1st April in Japan. So that actually explained that spike up in the yen strength against the dollar. That means conversely, that dollar yen coming down. All right. So this is what I share with you. And also another thing over here is the Aussie dollar is also a bit, yes, the Aussie dollar went up as well, but the Aussie dollar going forward in the last few sessions was weak because of a weaker Australia data. So if you look at today's Asia session, one more before we jump straight to the technical outlook, is that Australia, if you look at over here, yeah, retail sales. So retail sales in Australia, this is for the month of January, actually came in below expectation because market is expecting a recovery month on month to 1.5% year on year, month on month. Pardon me, it's not year on year, month on month. But the actual figures only came in 1.1% month on month, a slight lower bit. All right. So given what you see, weaker CPI monthly data that's out yesterday for Australia, then today we have a slightly lower upbeat retail sales figure coming in that's below expectation. So that could actually kind of see a what I call lackluster Aussie dollar in the short term at least. All right. So now with that, let us straight jump into the technical outlook. Okay, so let us start with the FX pair first. All right. So FX pair over here, let me start with the euro dollar. All right, euro dollar. Okay, pardon me, my screen is a bit hang at the moment in time. Okay, now let me expand my screen so that you guys could see much clearer. Okay, good. All right, so if you look at the euro dollar yesterday, euro dollar actually did a bit of a whipsaw around the pivotal support level, but managed to hold above the 20-day moving average before surpassing back up again. All right, and right now in today's Asia session, it traded sideways but managed to hold above the 200-day moving average. All right, so bear in mind, this is trading view chart. Yeah, even though I'm flashing the hourly time frame, this moving average over here is not based on calculated by the hour, it calculated by the day. So that I could do what I call multi-time frame analysis on a single chart by plotting in a higher time frame moving average on a lower time frame chart. It saves me time from switching the chart from hourly to daily. All right, so that's the benefit of using trading view. So what you could see over here is that euro dollar is right on support level, so we do not want to change the short-term bullish outlook on the euro dollar, so still using 10810 as a short-term pivotal support level. First resistance to watch was here. It got to surpass this minor swing high area of last Thursday at 1.0890 to gain any further potential upside trajection or traction over here. All right, so and also the close to the 50-day moving average acting as a resistance as well. However, an hourly close or breakdown below 1.0810 level will negate this short-term bullish outlook to see a further slide to retest the next support level at the 50% and the 61.8 Fibo retracement of that previous minor push-up from 14th of Feb to 22nd of February, acting as also a confluence this in the minor congestion support level or zone at 1.0785 / 1.0760 sterling dollar. So sterling dollar no change. It continued to actually trade sideways within the, but still holding above the 20-day moving average that was tested yesterday and bounced, and also right above this minor ascending trend line support that I drew from the low of 14th of February. So no change. 12610 short-term pivotal support, still maintain that short-term bullish outlook, but for sure it got to break up above this near-term resistance, near-term range resistance that is in place since 22nd of February at 127 figure level. Above this level exposes the next intermediate resistance zone at 12470, 12740, pardon me, 12760 level over here. Okay, this is the zone. So this zone over here is also correspond to the minor swing high of 15th of Jan all the way to 2nd of February. Only an hourly close below 12610 will negate this short-term bullish outlook to see to unleash a potential extension of the minor corrective decline towards the next support level, or exposing the next support level at the 200-day moving average 12560/12540. 12540 is the minor swing low area of 14th of Feb and 15th of February. Okay, Asia Pacific currency, dollar yen. So dollar yen, this is the big movement intraday that we saw right at the short-term pivotal support that we've been highlighting in the last 2 weeks breakdown. So right now is coming to actually test the 14960 level. 14960 level. So 14960 level is something like a range support level that is in place since 15th of February, and right now also the 200-day moving, not 200-day, the 20-day moving average as well. So with that, right, I do not want to type the pivotal support level to too tight because then we'll whipsaw. So what I could see over here is that the RSI really hit the oversold level. So the hourly RSI hit the oversold level, but there's no bullish divergence yet. So potentially we may see a bit of pullback or snapback, minor snapback coming forward. There's a risk of it. All right, so this snapback level, okay, potentially could be this level here. Yesterday's European session swing low area at the start of the US session swing low area before the bounce. Okay, not yesterday, Tuesday. Okay, Tuesday. This last minor swing low that bounced but rejected by the pivotal support before today's sell-off. So this is something like a former minor swing low turns into a pullback support. Put it this way, all right, 105.17. All right, this could be the potential pullback level to watch. So still using the 105.70, 105.80 as the short-term pivotal resistance. As long as any potential snapback didn't surpass this level, this short-term pivotal resistance level, 150.80. Sorry, today is a bit tongue twisting. Let me repeat again. As long as there could be a chance of a potential snapback rally. Why? Because the hourly RSI is at the oversold level. First snapback rally resistance to watch will be at 105.17, means 150.17, former minor swing low area. But I do not want to use this level as a short-term pivotal resistance today because it may whipsaw, because this is not a key level. The key level still remains at 150.70, 150.80. All right, so any potential snapback rally or snapback push up didn't surpass 150.70, 150.80. I will still maintain that short-term bearish bias, with the next support level to watch will be the zone at 148.80, 148.40. However, an hourly close above 150.80 will invalidate this short-term bearish bias to see a squeeze up to test the major resistance zone of 151.40, 151.95. Why this is a major resistance zone? If you look at the daily chart, it's very obvious. This is the top, the major top, one time, two time, and right now it's shaping this bearish medium-term reversal as well. Right, very clearly the RSI is also topping right below the overbought level. This is on the daily chart, so you could really see very clearly the price action why the 151.95 is a major resistance level. Okay, so with that, the Aussie dollar. So Aussie dollar yesterday we were bearish. It hit the 65 level. First support, the second support was 64.70, and today it did a bounce over here from a oversold level. So where it bounced from the oversold, right? This where it hit the oversold, there's no bearish, there's no bullish divergence over here at this point in time. So what I could see over here is that this bounce over here is more like a retracement of a relatively extreme oversold region, rather than a significant potential recovery. So with that, right, I'll be using the 20-day moving average as today's short-term pivotal resistance level. Okay, so this 20-day moving average, right, if you look at the last this push down, this last push down over here, okay, it's also 50%. Okay, the 50% retracement level. Okay, so as long as this 65.30 short-term pivotal resistance holds for today, the Titan resistance, potentially the Aussie dollar could actually shape another potential down leg, minor down leg. So we will still maintain that bearish bias on the Aussie dollar, given no clear signs of potential recovery based on the technical elements. Next support level to watch on the near term will be 64.70 for sure, 64.70. All right, also close to the 76.4 Fibo retracement of that previous minor push up from 14th of Feb to 22nd of February. Okay, only an hourly close above 65.30 will invalidate this short-term bearish bias on the Aussie dollar to potentially see a squeeze up to retest the 200-day moving average, I think as a resistance as well, at 65.60/65.80 over here. This 65.80. All right, 65.80. Okay, this zone. All right, so net overall, we are seeing potentially dollar strength weakness on the major pair that I shared with you, with the exception of Aussie dollar. Now, benchmark indices. Let us start with the Asia one. So for Asia over here is that we managed to see a bounce in today's Asia session on the Hong Kong 33. So this is the short-term pivotal support that we have already been predefined since the start of this week, 16,350. So still no change, still using 16,350 to maintain the potential short-term bullish bias within this minor counter trend rebound scenario that is still unfolding on the Hong Kong 33/Hang Seng Index that is in place since 22nd of January 2024 low. So as long as 16,350 holds, we will still maintain that short-term bullish bias for this potential minor counter trend rebound scenario to play out. For sure, it got to break out above 16,860 to gain more traction towards the to expose the next near-term resistance zone of 17,010, 17,130 Fibo extension cluster, and as well as the minor swing high area of 28th of December to 22nd of January. Only an hourly close below 16,350 will negate this bullish tone to see the extension of this minor corrective decline to test the 20-day moving average, I think as support, and the 50-day moving average, I think as support. And the lower channel, the lower boundary of this minor ascending channel from the low of 22nd of Jan, all confluencing at a similar support zone of 16,140/15,950. Okay, Nikkei 225. So Nikkei 225 managed to help right at the pivotal support that we highlighted on last Friday, 38,850. So we are looking for that pullback. Yeah, the pullback now is taking shape. But what's interesting, this pullback over here is that after coming close to the 38,850 short-term pivotal support level, the price action, yes, we see a lower low over here, but the RSI now is doing what I call a higher low. Okay, so this is what I call a bullish divergence. Indicate to us that this minor pullback, right, from the high, from the resistance of 39,510, 39,600 level, is now the downside momentum is losing initial. Okay, with downside momentum losing strength, that means this could be the start of a potential bullish reversal taking shape. All right, given the technical elements that I shared, that I explained to you by that bullish divergence being seen on the hourly RSI. So still no change, right? For sure, this is a key support level to watch, 38,850, and after the close to the test of it, the divergence takes shape. So this is more like a make or break level already for the potential boost to survive. So 38,850 short-term pivotal support holds. For now, we will still maintain that bullish outlook, short-term bullish bias, pardon me, on the Japan 225, but I have a near-term resistance to watch right now, which is yesterday's US session high, which is also the former minor swing low, now turns into a pullback support level, as pullback resistance level as well, that was rejected earlier at the start of the Asia session, 39,190. All right, so a break above 39,190 exposes the next resistance level, which is the minor swing high area of last Friday at 39,600. However, an hourly close below 38,850 will invalidate this short-term bullish bias to see the continuation of this minor corrective decline scenario to test the next support level, which is also confluencing with the 20-day moving average and as well as the medium-term ascending channel lower limit that is in place since 4th of Jan, that means the start of this year, all confluencing at this support zone of 38,450, 38,100 level. Okay, so that's for the Japan 225. German 30, or the DAX index over here, going to be very, very strong, much stronger than the US indices yesterday, as there's no minor pullback, but it managed to continue to test the upper limit of this ascending channel, which is at close to the 17,630 level. All right, so I did mention that around this zone here, 17,590/17,630 now is the upper limit. There could be a risk of a pullback, so the pullback level, the near-term pullback level to watch will be at 17,510 level, which is the median line, the dotted median line of this minor ascending channel that I drew from 14th of February. But I will use it a slightly lower level for today. That means this is the minor swing high of 26th of February, slightly tighter, 17,450. So as long as any potential pullback managed to hold above 17,450, we will still maintain that short-term bullish outlook on the German 30. Next resistance to watch will be at 16,780, 17,680, 17,730 level. Okay. However, a breakdown below 17,450 will see the much more pronounced minor corrective pullback to retest the lower limit of this minor ascending channel, also confluencing at the next support zone at 17,360, 17,290. And if you look at the Fibo retracement of this ongoing short-term impulsive up move to yesterday current high, is at the 38.2% Fibo retracement level. All right, then Dow Jones, US Wall Street 30. So US Wall Street 30 going to shape the bounce right after a test at that 38,770 short-term pivotal support level. All right, it bounced off from there. RSI also going to shape a higher low after the bullish divergence that was seen earlier. So no change for sure. This is the key support level to maintain that short-term bullish bias on the US Wall Street 30. 38,770 short-term pivotal support holds, still maintain that short-term bullish bias on Wall Street 30. First resistance to watch will be at 39,100, which was the minor swing high area of last Tuesday. Only above this level potentially expose the next intermediate resistance at 39,400. However, an hourly close below 38,770 will negate this short-term bullish tone to see the extension of this minor corrective decline to retest the minor swing low area of 21st of Feb and the congestion area of 15 and 15 of Feb at 38,430, 38,360. Nasdaq 100. So no change. Nasdaq 100 going to trade sideways yesterday, okay, between 18,030 and the near-term support of 17,810. All right, so given today is also a month-end closing, so month-end closing, there could be a bit of volatility taking shape, higher volatility taking shape. So I do not want to tighten it to what 17,810 level for the Nasdaq 100. So still using the 17,650 short-term pivotal support that we have originally since late last week to maintain that bullish bias on the Nasdaq 100. So as long as any potential pullback holds at the 17,650 level, still maintain that short-term bullish bias. For sure, the first near-term resistance to watch will be at 18,030. Only a clear break above 18,030 exposes the next intermediate resistance zone at 18,220/18,270. However, if you see an hourly close below 17,650, will invalidate this short-term bullish bias to see the extension of a minor corrective decline to retest the swing low area of 22nd of February at 17,350. We're also converging with the upward sloping 50-day moving average coming in at a similar level as well at 17,350. All right, so net what we could see over here is that all the major stock indices they are still holding above or maintaining above, i.e. their respective short-term pivotal support level that I highlighted earlier on. So now moving on next to gold, spot gold. Okay, so for spot gold, for sure it's continued to, like I mentioned earlier at my start of the earlier daily dose that the 10-year US Treasury yield has an indirect correlation with the gold, spot gold. As long as the US 10-year Treasury yield still trading a sideways motion, spot gold potentially, right, will find it very tough to break above the 2042. But initially, it's still positive. Why? Because it's going to hold above the 20-day moving average. All right, as well as the 50-day moving average as well, trying to attempt to hold above this level yesterday, which is rather positive, I would say. So still no change using the 2022 level as my short-term pivotal support level. Still maintain this potential bullish outlook on spot gold XAU/USD for a kind of a potential bullish breakout. So in order for the bullish breakout to transpire, you got to for sure break above 2042 level. So what's 2042 is in fact the upper limit of this on symmetrical triangle range configuration that is in place since 13th of December last year. So you look at these two lines, these two gray lines, the way the price action moves up. All right. So a breakout above 2042 will transpire a potential bullish breakout, exposes the next intermediate resistance in the first step at 2059/2064. However, if we start at hourly close back below 2022, that means also back below the 20-day moving average, also acting as a support around at the 2022 level, then we will invalidate this bullish outlook scenario, short-term breakout scenario for the price to do or spot gold XAU/USD to do a mean reversion push down towards the lower boundary, towards the lower end, towards the median portion of the symmetrical triangle range configuration at 2011. A breakdown to the 2011 potentially exposes 1965, which is also close to the lower limit of that symmetrical triangle range configuration. Then lastly will be West Texas oil. So West Texas oil has been in a very whipsawish configuration since the start of this week. So yesterday it did a push up above 79 figure, but can't break above 79.80. So what 79.80 is the minor swing high area of 14th of November and 30th of November last year. Then it's tried to reintegrate back into that symmetrical triangle range configuration as depicted by the gray line here, the upper boundary. So with that, right, given such mixed element, I will have a neutrality stance for today. That means I flip from a bearish bias to a neutrality stance below yesterday's swing up, using the upper limit as yesterday's swing high as the upper limit. It means yesterday's intraday high as upper limit 79.80. Lower limit will be slightly below the 200-day moving average, which is this V-shaped movement, minor V-shaped movement of this Tuesday at 77.50. So neutral between these two levels. However, if we see a hourly close above 79.80, then potentially we may start to see a more substantial bullish breakout to expose the next intermediate resistance in first step at 81.65. So what's 81.65? 81.65, if I go to the 4-hour chart, be pretty much clear. So 81.65 is in fact this level here. Okay, this former minor swing low breakdown turns into a pullback resistance, and also the former medium-term decline of 28th of September high to 13th of December last year low, the 50% Fibo retracement as well. That's confluencing at the 81.65 level. All right. So with mixed element, we'll be turning neutral for today on West Texas oil. All right. So before we go, today it will be a slightly later daily dose because I need to explain to you all the various key event that has taken shape so far, which is important. So that if you don't mind, it's a slightly longer daily dose session for today, because hoping that you guys could have a better understanding on the markets by me helping you to link up the dots in terms of intermarket correlation. Okay, key important data that I've been stressing for today is in the US session will be the US PCE data. Okay, so the US PCE data, why is it important? Is out later at 9:30 p.m. Singapore time, because this is the preferred inflationary gauge that the Federal Reserve official are watching. So for the year-on-year, the PCE, the core PCE one, that's important because that is excluding energy and food, the more volatile item. Year-on-year, market is expecting a slightly inch down of 2.8% year-on-year from 2.9% year-on-year printed in December. So that's pretty much important. So any data that is going above market expectation, especially if going above 3% or more, so that could actually create a near-term shock to the market. That means, i.e., risk-off behavior may take shape, if the core PCE price came in at 3% or more, that means we see a spike up in the US 10-year Treasury yield, a spike up in dollar strength, and a minor negative near jerk reaction or a minor risk off in the stock indices. All right, and after that we do have another Fed speak. Bostic will be speaking again at 11:50 p.m. Singapore time, followed by another official Fed Goolsbee at 12 a.m. Singapore time. So with that, that pretty much sum up for today. And also before tomorrow, daily dose of market insight starts at 11 a.m. At 9:30 a.m. Singapore time tomorrow, Friday, we have key China data, which is the official MBS manufacturing PMI and the non-manufacturing PMI for February. All right, so this is another important data to watch. Why? To see to gauge the deflationary risk spiral that is still prevailing, the degree of it in China. Okay, so with that, thank you for your time and have a great day ahead, and we shall speak again tomorrow. Thank you.